my name is Mary Pearl Pariado. I'm a course tutor for corporate financial analysis. In this session, we are going to study the analysis of changes in income. So usually we refer to income as profits or net income. But what exactly is income? So by the end of this session, you should be able to explain what income means, distinguish between economic concepts of income and accounting concepts of income, and also measure income using different approaches and identify factors that are responsible for changes in income. Now, income is one of the main or key items that holds financial statements, and this income changes over time. Hence, we would want to analyze what causes these changes in income of firms or businesses over a period of time. So when we say income, we are trying to refer to increases in economic benefits during the accounting period in the form of inflows or enhancements or improvements in assets, or probably decreases in the liabilities of the firm that will result in increase in equity, other than those that relate to contributions that have been made by equity participants or shareholders. In other words, we know that the accounting equation is that asset is equal to capital plus liabilities. So any increases in your assets as a firm or any decreases in your liabilities, that would result in you having a higher capital or equity than the business originally started with. That excess or that surplus is what we refer to as income. Now, according to Harry Norris, income is generally conceived to be the residue that emerges out of matching cost against revenue. Income is defined as the net increase in net assets of the enterprise when you are seeing it from the point of the statement of financial position. But when it comes to the income statement, when your revenue exceeds your cost or your expenses, that is when you say you have income. So from the accounting concept of income, when you have excess of total revenue over your expired cost, which is also known as your expenses, then we can say that you have income. So the excess or the surplus of total revenue, or when your total revenue exceeds your expired cost or your expenses, then we have income. And it is mathematically represented in this manner, where I is your accounting income, which is equated to your revenue from operating expenses plus any other incidental gains that you make in the course of your business, minus the sum of your expenses, which are your expired costs, plus other incidental losses that you may occur during your business endeavors. So the difference between these two is what we refer to as income. Now, from the economist perspective, income is defined as the net increase in capital of the firm during the period. Like I mentioned earlier, firms have capital that they begin the business with or that they commence the business with. Now, if you compare your capital from the beginning of your business journey to the end of the journey, any increase or any surplus in income or any increase in your capital within that period is what we refer to as income. And your increases in capital would come or would happen as a result of either an increase in your assets as a firm or the decreases in your liabilities that the firm has. Now, this net increase in capital is simply the difference between your closing capital and your opening capital. And usually you would want to adjust this for any capital, additional capital that was introduced within the period or any adjustment of capital that was consumed. So it could happen that during the course of that period, there was a regulatory requirement to increase or to have something, so you had to fall upon your capital, and therefore your initial capital has a business, part of it got consumed, you want to adjust it, or there was the need for you to, or the need for shareholders to introduce more capital into the business, and therefore additional capital was introduced into the business, you do also want to adjust for that. So in summary, the income is just the difference between the capital employed in the firm at two different points in time. So when there's increase in that capital from the beginning to the end, then you can say there's income. So mathematically, economic income is denoted in this way. We have E, which represents economic income, and that's equated to, we deal with the brackets first. That's the difference between the capital at the end of the period and the beginning of the period. So capital at the end minus capital at the beginning. That difference minus any fresh capital that was introduced in the course of the business added to the consumption of capital during the period. In case you took out or you consumed any capital within the period, when you add that, that would be your economic income. Now there are various approaches to measuring income, and the transaction approach is one of them. So this approach measures income by deducting any related expired cost from the revenue received out of the transaction. Now, revenues and gains that arise out of transactions are considered on realized basis. So it's actually the money you received or you realized out of the sale, or any gains that you have realized for real, like real gains, not assumed gains, or gains that you are assuming you would gain in the future, but those that have actually been realized. On the other hand, expired costs that arise out of these transactions are also taken into account. So for example, if you have to purchase um you have a laptop, okay, that you purchased at a certain price, and you sold that laptop, the revenue would be the money or the funds you received from selling the laptop, and the expired cost would be that money you paid in order to acquire that laptop you actually sold out. So this approach is popularly and widely used because it is very simple to actually understand. Now, also when it comes to the statement of financial position approach to income, you measure income by the net change in the net assets of the firm during an accounting period. By net assets, I mean the difference between your total assets and your total liabilities. So when you have excess of total assets with respect to your total liabilities, then you have net assets. Now, adjustment is also made for fresh capital that is introduced, and also withdrawals of capital, if any, during the period when calculating for the net changes or the changes in net assets. Income is only recognized when your capital increases. In cases where your capital at the end of the period is less than your capital at the beginning of the period, then it is not income because your capital has actually decreased. Also, there are a number of factors that are responsible for changes in income, and one of them is sales volume. So your income will increase or your profits will increase only when your sales volume increases. So when you're able to sell more quantities of products, or when you're able to offer more services or sell more goods, then your sales volume will increase, and it will lead to an increase in your income or your profits. Also, increases in the unit selling price can also account for increases in income or profits. So we know that sales revenue is obtained when you multiply the cost or the selling price by the quantity sold. So when you increase your selling price, then automatically your sales revenue would increase. And when your sales revenue increases, that means you are increasing your income or your profits. Also, When there are decreases in the unit cost price of the products that the company sells, then that would result into an increase in the income or the profits, in the sense that your cost will be lower, so you can be able to purchase a lot of the raw materials at a lower cost. That would make you be able to sell and gain more profit or income. Also, reduction in waste and efficient material controls can also help to increase the income or the profit of the firm. Conversely, these are the same factors that are responsible for decreasing income: sales revenue, unit selling price, unit cost price, and also waste and material control. So if you are able to, or if the company is not able to make enough sales volume, or there are decreases in the sales volume or quantities of goods that are sold or services that are rendered, then the company would experience a decrease in profit or income. Also, when the company reduces its unit selling price, then income and profits would also be reduced. Also, when there is an increase in the unit cost price, if the firm has to pay more cost or incur more cost on each product or good it sells, or on each service it renders, then it would reduce the income or profit of the firm. Also, when there's a lot of waste and the material controls are not efficient, income or profit will also be reduced. So in this session, we discuss how to measure income according to the traditional measures and also the accounting income and economic income. We also identify the factors that might increase or decrease a firm's profit or income, and they include the unit selling price, the unit cost price. They include the sales volume or the quantities of goods and services that are sold or rendered, and also the efficiency of the material control system or the ability of the firm to reduce waste. Thank you.